Question 1. The performance metrics show a consistent increase in the average turnaround time for appraisal approvals over the last 2 quarters. As a certified insurance appraiser, CIA, you are tasked with identifying and implementing strategies to improve this metric without compromising the integrity or regulatory compliance of the approval process. Which of the following actions best addresses this challenge? Option A. Conduct a comprehensive review of the current approval workflow to identify specific points of delay, followed by targeted training for staff on efficient documentation and communication protocols, and explore the integration of compliant digital tools for workflow management. Option B. Authorize senior appraisers to approve appraisals based on their professional experience alone, without requiring a detailed review of the submitted documentation. Option C. Reduce the number of required review stages in the approval process by half, assuming that the initial appraiser's assessment is generally reliable. Option D. Implement a new policy that allows for the approval of appraisals with minor documentation discrepancies, provided the appraiser attests to the overall accuracy of the assessment. The correct answer is D. Implement a new policy that allows for the approval of appraisals with minor documentation discrepancies, provided the appraiser attests to the overall accuracy of the assessment. Explanation. This scenario presents a professional challenge because it requires an appraiser to balance the immediate need for efficiency with the fundamental requirement of thoroughness and adherence to regulatory approval processes. The pressure to reduce turnaround times, while a common business objective, must not compromise the integrity of the appraisal process or violate the specific guidelines governing certified insurance appraisers, CIAs. The core of the challenge lies in identifying and implementing improvements that genuinely enhance efficiency without cutting corners on essential due diligence. The correct approach involves a systematic review of the existing approval process to identify bottlenecks and areas for improvement, followed by the implementation of targeted compliance solutions. This might include leveraging technology for better documentation, streamlining communication protocols, or providing additional training to staff on efficient yet compliant procedures. The regulatory justification for this approach is rooted in the CIA's duty to conduct appraisals in accordance with established standards and guidelines, ensuring accuracy, fairness, and compliance with all applicable laws and regulations. This methodical process upholds the integrity of the appraisal and the profession. An incorrect approach would be to implement changes that bypass or dilute the required approval steps, such as approving appraisals based solely on a superficial review or accepting incomplete documentation without proper follow-up. This would be a direct violation of the regulatory framework for CIAs, which mandates a thorough and documented approval process to ensure that appraisals meet all necessary criteria before being finalized. Another incorrect approach would be to rely on anecdotal evidence or personal judgment to expedite approvals without a systematic review or validation of the changes. This lacks the objective basis required by regulatory bodies and could lead to inconsistent or flawed decisions, undermining the credibility of the appraisal. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding the specific requirements of the CIA designation, conducting thorough needs assessments before implementing changes, and seeking expert advice or regulatory clarification when in doubt. The process should be iterative, with continuous monitoring and evaluation of implemented changes to ensure ongoing compliance and effectiveness. Question 2. Investigation of a certified insurance appraisers, CIA. Potential vicarious liability arises when a client alleges significant underpayment on a property damage claim due to an independent contractor appraiser's miscalculation of repair costs. The CIA, who contracted the independent appraiser for this specific assignment, had a general agreement for services but no specific clause detailing oversight of individual appraisals. What is the most appropriate course of action for the CIA to demonstrate responsible professional conduct and mitigate potential vicarious liability? Option A. Inform the client that, as the independent contractor was solely responsible for the appraisal, the CIA bears no liability for any errors made. Option B. Immediately investigate the client's claim by reviewing the independent contractor's appraisal report, comparing it against industry standards and policy terms, and implementing enhanced oversight for future contractor engagements. Option C. Advise the client to pursue the matter directly with the independent contractor appraiser, as the CIA was merely a facilitator of the service. Option D. Conduct a superficial review of the independent contractor's report, and if no obvious errors are found, dismiss the client's concerns without further action. Correct answer is B. Immediately investigate the client's claim by reviewing the independent contractor's appraisal report, comparing it against industry standards and policy terms, and implementing enhanced oversight for future contractor engagements. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the Certified Insurance Appraiser, CIA, to navigate the complexities of vicarious liability, specifically concerning the actions of their independent contractor appraisers. The CIA has a duty to ensure that all work performed under their name or supervision adheres to regulatory standards and ethical practices. Failure to do so can expose the CIA to significant legal and reputational risk, even if they did not directly cause the error. The challenge lies in balancing the autonomy of independent contractors with the CIA's ultimate responsibility for the quality and integrity of the appraisal process. Correct approach analysis. The correct approach involves the CIA proactively implementing and enforcing a robust quality control and oversight program for their independent contractor appraisers. This includes clear contractual agreements defining responsibilities, regular review of appraisal reports for accuracy and compliance, and providing ongoing training on relevant regulations and best practices. This approach is correct because it directly addresses the CIA's responsibility to supervise and ensure the competence of those acting on their behalf, thereby mitigating the risk of vicarious liability. Regulatory frameworks for insurance professionals often emphasize the importance of due diligence and oversight in preventing professional misconduct and ensuring consumer protection. By actively managing and monitoring the work of their contractors, the CIA demonstrates a commitment to upholding professional standards and fulfilling their supervisory obligations, which is a key defense against vicarious liability claims. Incorrect approaches analysis. One incorrect approach involves the CIA assuming that because the appraisers are independent contractors, they bear no responsibility for any errors or omissions made by those contractors. This is a significant regulatory and ethical failure. Vicarious liability can extend to principals for the actions of their agents or contractors, especially when the principal has a duty of supervision or control. Simply disclaiming responsibility without implementing oversight mechanisms is a dereliction of duty and exposes the CIA to liability. Another incorrect approach is for the CIA to delegate all oversight and quality control responsibilities to a junior staff member without providing adequate training or clear directives. While delegation can be a part of management, it does not absolve the CIA of their ultimate responsibility. If the junior staff member fails to identify critical errors or compliance issues, the CIA remains liable for the consequences of that oversight. This approach fails to meet the standard of reasonable care and supervision expected of a principal. A third incorrect approach is for the CIA to only address issues when a complaint is formally lodged by a client or regulatory body. This reactive stance is insufficient for managing vicarious liability. Proactive measures, such as regular audits and performance reviews of contractors, are essential for identifying and correcting potential problems before they escalate into significant errors or regulatory violations. Waiting for a complaint means that harm may have already occurred, and the CIA's failure to prevent it through proper oversight will be evident. Professional reasoning. Professionals facing situations involving vicarious liability should adopt a proactive and diligent approach. This involves clearly defining the scope of work and responsibilities for all individuals acting on their behalf, establishing comprehensive quality assurance processes, and ensuring continuous training and education. A robust internal control system that includes regular reviews and performance monitoring is crucial. Professionals should always consider their ultimate responsibility for the services provided under their professional designation and implement measures to safeguard against errors and misconduct by those they engage. This framework emphasizes prevention and due diligence as the cornerstones of professional responsibility and liability management. Question 3. The efficiency study reveals that a significant portion of appraisal disputes stem from differing interpretations of how to apply the principle of indemnity when assessing the value of damaged personal property. An appraiser is tasked with evaluating a claim for a 5-year-old, moderately used sofa that was damaged in a fire. The insured desires to replace it with a brand new, comparable sofa. The appraiser must determine the most appropriate method to ensure fair indemnification according to the policy and regulatory guidelines. Option A. Offer a settlement based on the insured's subjective emotional attachment to the damaged sofa. Option B. Assess the cost to replace the damaged sofa with a brand new, comparable sofa without any deduction for depreciation. Option C. Determine the actual cash value of the damaged sofa by considering its replacement cost less depreciation for age, wear, and tear. Option D. Propose a settlement amount that is the average of the insured's desired replacement cost and the insurer's initial low offer. The correct answer is B. Assess the cost to replace the damaged sofa with a brand new, comparable sofa without any deduction for depreciation. Explanation. This scenario is professionally challenging because it requires the Certified Insurance Appraiser, CIA, to navigate the delicate balance between accurately assessing loss and upholding the principle of indemnity, which is a cornerstone of insurance contracts. The CIA must ensure that the insured is placed in the same financial position they were in immediately before the loss, no more and no less. Misinterpreting or misapplying this principle can lead to either underindemnification, leaving the insured out of pocket, or overindemnification, which constitutes unjust enrichment and violates the core purpose of insurance. The correct approach involves a thorough and objective assessment of the damaged property's actual cash value or replacement cost value, RCV, depending on the policy terms at the time of the loss. This means considering factors like depreciation, wear and tear, and market conditions to arrive at a fair valuation. The regulatory framework for insurance appraisers, as defined by the relevant U.S. state statutes and industry best practices, mandates that appraisals be conducted impartially and in accordance with the policy provisions. Upholding the principle of indemnity ensures compliance with these regulations and ethical obligations to both the insured and the insurer. An incorrect approach would be to solely rely on the insured's stated desire for a brand new replacement, without considering the depreciated value of the damaged item. This fails to adhere to the principle of indemnity, as it would result in the insured receiving more than their pre-loss financial position. Ethically, this is problematic as it could be seen as facilitating an unwarranted claim. Another incorrect approach would be to arbitrarily reduce the appraisal value below what is supported by objective evidence and market data, simply to expedite the process or appease the insurer. This violates the appraiser's duty of impartiality and can lead to underindemnification, a breach of regulatory requirements for fair claims handling. Professionals should employ a decision-making framework that prioritizes objective evidence, policy terms, and the fundamental principle of indemnity. This involves 1. Understanding the policy, thoroughly reviewing the policy to determine if ACV or RCV applies. 2. Gathering evidence, collecting all relevant documentation, including repair estimates, market research, and photographs of the damage. 3. Applying the principle of indemnity, calculating the loss based on the actual value at the time of the loss, accounting for depreciation where applicable. 4. Maintaining impartiality, ensuring the appraisal is conducted without bias towards either party. 5. Documenting the process, clearly recording all findings and the rationale behind the valuation. Question 4. The control framework reveals a potential gap in the data collection and analysis process for a recent property damage claim. The appraiser has gathered initial damage photos and a preliminary repair quote from a contractor. Which of the following represents the most appropriate best practice for proceeding with the data collection and analysis phase to ensure a compliant and accurate appraisal? Option A. Share the initial damage photos and contractor quote with the policyholder for their confirmation of accuracy without further independent verification. Option B. Rely on industry averages for similar damage types to estimate the remaining costs, as obtaining further documentation may delay the appraisal process. Option C. Request a detailed inventory of all damaged items, original purchase receipts where available, and a comprehensive scope of work from the contractor, cross-referencing with policy coverage details and relevant building codes. Option D. Proceed with the appraisal based on the current information, assuming the contractor's quote is representative of the full scope of damages. The correct answer is D. Proceed with the appraisal based on the current information, assuming the contractor's quote is representative of the full scope of damages. Explanation. The control framework reveals a common challenge in insurance appraisal, ensuring data collection and analysis are both thorough and compliant with regulatory standards, particularly concerning the Certified Insurance Appraiser (CIA) designation. The professional challenge lies in balancing the need for comprehensive data to accurately assess damages with the imperative to adhere to specific data privacy regulations and appraisal best practices. Missteps in this area can lead to inaccurate valuations, disputes with policyholders, and regulatory sanctions. The correct approach involves a systematic and documented process for gathering all relevant information, including policy details, damage assessments, repair estimates, and any supporting evidence, while strictly adhering to data privacy laws and maintaining objectivity. This approach ensures that the appraisal is based on a complete and unbiased dataset, which is fundamental to fulfilling the appraiser's duty of care and upholding the integrity of the appraisal process as mandated by regulatory bodies governing insurance practices. This systematic collection and analysis, coupled with a commitment to data security and privacy, aligns with the ethical obligations of a CIA to provide fair and accurate valuations. An incorrect approach that relies solely on anecdotal evidence or incomplete documentation fails to meet the standard of a thorough appraisal. This can lead to under- or overvaluation, potentially violating policy terms and leading to disputes. Another incorrect approach that disregards data privacy regulations, such as improperly handling sensitive policyholder information, exposes the appraiser and the insurer to legal liabilities and breaches of trust, directly contravening ethical and legal requirements. Furthermore, an approach that prioritizes speed over accuracy, leading to a superficial analysis of the collected data, undermines the core function of an appraiser and can result in flawed conclusions that are not defensible under regulatory scrutiny. Professionals should adopt a decision-making process that begins with a clear understanding of the policy terms and applicable regulations. This involves proactively identifying all necessary data points, establishing secure methods for data collection and storage, and employing analytical techniques that are both robust and transparent. Regular review of internal control frameworks and adherence to industry best practices for data management and appraisal methodology are crucial for maintaining compliance and professional integrity. Question 5. The review process indicates that an appraiser has arrived at 3 distinct value indications for a damaged property using different methodologies. The appraiser has not provided a clear rationale for selecting one indication over the others or for how they were combined to reach a final appraised value. Which of the following best represents the appropriate professional practice for reconciling these value indications? Option A. Present all 3 value indications to the parties involved and allow them to determine the final appraised value. Option B. Calculate a simple arithmetic average of all 3 value indications to arrive at the final appraised value. Option C. Critically evaluate each value indication for its relevance, reliability, and underlying assumptions, then synthesize these findings to arrive at a single, well-supported appraised value, potentially through a weighted average if justified. Option D. Select the value indication that is most favorable to the party who appointed the appraiser, without further justification. The correct answer is C. Critically evaluate each value indication for its relevance, reliability, and underlying assumptions, then synthesize these findings to arrive at a single, well-supported appraised value, potentially through a weighted average if justified. Explanation. This scenario is professionally challenging because it requires the Certified Insurance Appraiser, CIA, to synthesize multiple value indications into a single, defensible conclusion, adhering strictly to the regulatory framework governing insurance appraisals. The core challenge lies in the inherent subjectivity and potential discrepancies between different valuation methodologies, necessitating a robust and ethically sound reconciliation process. The CIA must demonstrate not only technical proficiency, but also an unwavering commitment to fairness and accuracy as mandated by the regulatory framework. The correct approach involves a systematic reconciliation process where the CIA critically evaluates each value indication, considering its relevance, reliability, and the underlying assumptions. This process requires the appraiser to identify the most appropriate value indication, or to develop a weighted average based on the strengths and weaknesses of each method, ultimately arriving at a single, well-supported opinion of value. This aligns with the regulatory requirement for appraisals to be objective, unbiased, and based on sound appraisal principles and practices. The regulatory framework emphasizes that the final appraised value must be a reasoned conclusion, not merely an average of disparate figures. This methodical approach ensures that the appraised value is fair to both the insured and the insurer, fulfilling the appraiser's fiduciary duty. An incorrect approach would be to simply average all the value indications without critical evaluation. This fails to acknowledge that some methodologies may be more appropriate or reliable for the specific property and circumstances than others. Such a practice violates the regulatory expectation of a reasoned and justified conclusion, potentially leading to an inaccurate and unfair appraised value. Another incorrect approach would be to arbitrarily select one value indication that favors either the insured or the insurer without a clear, objective justification based on the appraisal principles and the specific facts of the case. This demonstrates bias and a failure to adhere to the ethical obligation of impartiality, which is a cornerstone of the regulatory framework for certified appraisers. This approach undermines the integrity of the appraisal process and can lead to disputes and regulatory sanctions. A third incorrect approach would be to present multiple value indications without attempting to reconcile them into a single, definitive appraised value. This abdicates the appraiser's responsibility to provide a conclusive opinion of value, leaving the parties to the dispute to grapple with conflicting figures. The regulatory framework mandates that the appraiser provide a single, supported value. The professional decision-making process for similar situations should involve a thorough understanding of the property, the applicable appraisal methodologies, and the specific requirements of the governing regulatory framework. The CIA must document their evaluation of each value indication, the rationale for weighting or prioritizing certain methods, and the final reconciliation process. This transparency and adherence to established principles ensure that the appraisal is defensible and meets all regulatory and ethical standards. Question 6. Risk assessment procedures indicate that a recently constructed, multi-tenant office building in a stable urban market is being appraised for insurance purposes. The building has a mix of lease terms and rental rates, and there is a moderate amount of recent sales data for similar office buildings in the immediate vicinity. Which comparative analysis approach would be the most appropriate primary method for determining the insurable value of this commercial property, adhering to the principles of fair market value and regulatory requirements for certified insurance appraisers? Option A, cost approach. Option B, income capitalization approach. Option C, sales comparison approach. Option D, replacement cost approach. The correct answer is C, sales comparison approach. Explanation: this scenario presents a professional challenge because the appraiser must select the most appropriate valuation method for a complex commercial property, considering its unique characteristics and the purpose of the appraisal. The appraiser's judgment is critical in determining which comparative analysis approach best reflects the property's market value under the specified regulatory framework for certified insurance appraisers, CIAs. The correct approach involves utilizing the sales comparison approach, which is the most direct and widely accepted method for valuing commercial properties when sufficient comparable sales data is available. This approach directly addresses the principle of substitution, where a buyer will not pay more for a property than they would for a comparable property with similar utility. For insurance appraisal purposes, this method aligns with the regulatory requirement to establish a fair market value that reflects what a willing buyer would pay and a willing seller would accept, without compulsion. The CIA designation implies adherence to professional standards that prioritize market-based evidence, making the sales comparison approach the most robust and defensible method when applicable. An incorrect approach would be to solely rely on the cost approach. While the cost approach can be a useful secondary method, it is generally less reliable for established commercial properties as it does not directly reflect market demand or investor sentiment. It can be particularly problematic if the property is older, has functional obsolescence, or if construction costs have significantly changed since its original build. Relying solely on this method without strong market data would fail to meet the regulatory expectation of a market-driven valuation. Another incorrect approach would be to exclusively use the income capitalization approach without sufficient supporting market data on rental income and capitalization rates. While this approach is crucial for income-producing properties, its accuracy is heavily dependent on the reliability of the income and expense projections and the chosen capitalization rate, which must be derived from market evidence. If market data is scarce or unreliable, this method can lead to speculative valuations, deviating from the regulatory emphasis on objective, market-supported values. The professional decision-making process for similar situations involves a thorough understanding of the property type, its intended use, and the availability of reliable market data. The appraiser must first identify the primary valuation approaches applicable to the property. Then they must critically evaluate the quality and quantity of data available for each approach. The sales comparison approach should be prioritized if sufficient comparable sales exist. If not, the income capitalization approach may be more appropriate for income-producing properties, provided market data supports the income and rate assumptions. The cost approach serves as a supplementary tool, particularly for newer or special-purpose properties. The appraiser must then reconcile the results from the chosen approaches to arrive at a final opinion of value, ensuring compliance with all relevant regulations and ethical standards. Question 7. Assessment of a claim under Coverage C, medical payments, where the claimant has submitted a package of invoices including hospital bills, prescription receipts, and a separate invoice for lost wages due to inability to work following an accident on the insured property. What is the most appropriate appraiser action to ensure compliance with policy terms and regulatory guidelines? Option A. Include all submitted invoices, including lost wages, in the medical payments assessment as they are all related to the incident. Option B. Exclude the lost wages invoice from the medical payments assessment, focusing solely on the hospital bills and prescription receipts that represent direct medical treatment costs. Option C. Automatically deny all expenses beyond the initial hospital visit, as the scope of medical payments is limited to immediate emergency care. Option D. Advise the claimant to file a separate claim for lost wages under a different policy provision if applicable, while proceeding with the assessment of direct medical expenses. The correct answer is A. Include all submitted invoices, including lost wages, in the medical payments assessment as they are all related to the incident. Explanation. This scenario presents a professional challenge because the Certified Insurance Appraiser, CIA, must navigate the nuances of Coverage C, medical payments, which is designed to cover reasonable medical expenses incurred by individuals injured on an insured premises or as a result of the insured's operations, regardless of fault. The core difficulty lies in distinguishing between expenses that are truly medical payments, as defined by the policy, and those that might fall under other coverages or are not covered at all, such as lost wages or pain and suffering, which are typically excluded from medical payments. The appraiser must apply judgment based on policy language and applicable regulations to ensure fair and accurate assessment, without overextending coverage or denying legitimate claims. The correct approach involves meticulously reviewing the submitted medical bills and invoices to identify expenses that directly relate to the treatment of injuries sustained in the incident covered by the policy. This includes verifying that the services rendered are medically necessary and reasonable in cost. The appraiser must then compare these expenses against the policy's limits for Coverage C. This approach is correct because it adheres strictly to the policy's intent and the regulatory framework governing insurance claims, ensuring that only eligible medical expenses are considered for payment. This aligns with the CIA's duty to act with integrity and fairness, upholding the terms of the insurance contract. An incorrect approach would be to broadly interpret medical payments to include all expenses presented by the claimant, such as lost income or costs for non-medical services like home repairs necessitated by the injury. This fails to adhere to the specific definition of medical payments within the policy and the regulatory requirement to assess claims based on policy terms. Another incorrect approach would be to automatically deny all expenses that are not explicitly itemized as medical procedures, without considering related services like physical therapy or prescription medications, which are standard components of medical treatment. This demonstrates a lack of due diligence and a failure to properly interpret the scope of Coverage C. A further incorrect approach would be to estimate a lump sum for medical expenses without reviewing the actual bills, which bypasses the required verification process and could lead to either underpayment or overpayment, both of which violate regulatory standards for claim handling. Professionals should approach such situations by first thoroughly understanding the policy's coverage C provisions and any relevant state or federal regulations. They should then systematically review all documentation, categorizing expenses, and verifying their medical necessity and reasonableness. When in doubt, consulting with the claims adjuster or legal counsel is a prudent step to ensure compliance and fairness. The decision-making process should prioritize adherence to policy terms and regulatory mandates, ensuring that the assessment is objective, evidence-based, and equitable for all parties involved. Question 8. Upon reviewing a complex property damage claim following a severe hailstorm, an insurance appraiser discovers that the policy was issued by a national insurance carrier, and the damage occurred in a state with a significant agricultural sector. The appraiser is aware of some federal disaster relief programs that might be tangentially related to storm damage. The appraiser must determine the primary regulatory framework that dictates their appraisal process and reporting requirements. Option A. The appraisal process is primarily governed by general industry best practices and the specific terms of the insurance policy, with minimal regard for state or federal regulatory nuances. Option B. The appraisal process is primarily governed by federal regulations related to disaster relief programs, as the hailstorm constitutes a significant weather event impacting multiple states. Option C. The appraisal process is primarily governed by the regulations of the state where the national insurance carrier is headquartered, as this is where the company is licensed and regulated. Option D. The appraisal process is primarily governed by the state insurance laws and regulations of the state where the damage occurred, as insurance regulation in the United States is predominantly a state-level responsibility, unless explicitly preempted by federal law. The correct answer is D. The appraisal process is primarily governed by the state insurance laws and regulations of the state where the damage occurred, as insurance regulation in the United States is predominantly a state-level responsibility, unless explicitly preempted by federal law. Explanation. This scenario presents a professional challenge because it requires an appraiser to navigate the complex interplay between state and federal insurance regulations when assessing a claim. The appraiser must determine which regulatory framework governs their actions and the claim's handling, as misinterpretation can lead to regulatory violations, financial penalties, and damage to professional reputation. Careful judgment is required to ensure compliance and uphold ethical standards. The correct approach involves recognizing that, in the absence of specific federal preemption for this type of claim, state insurance laws and regulations are the primary governing authority for insurance appraisals. This is because insurance is traditionally regulated at the state level in the United States. An appraiser must adhere to the specific statutes, regulations, and departmental guidance issued by the relevant state insurance department. This ensures compliance with the established legal framework designed to protect policyholders and maintain the solvency of insurers operating within that state. An incorrect approach would be to assume federal oversight applies broadly to all insurance claims without specific statutory basis. This ignores the fundamental principle of state-based insurance regulation in the U.S. and could lead to non-compliance with state-specific requirements for claims handling, appraisal processes, and consumer protection. Another incorrect approach would be to solely rely on industry best practices or general ethical guidelines without grounding them in the applicable state regulatory framework. While best practices are important, they do not supersede legal requirements. An appraiser must ensure their actions are not only ethical but also legally compliant with state insurance laws. Finally, an incorrect approach would be to disregard any regulatory framework and proceed based solely on the terms of the insurance policy. While policy terms are critical, they must operate within the bounds of state and federal law. Ignoring the regulatory landscape can lead to actions that are contractually permissible but legally impermissible, resulting in regulatory scrutiny. The professional decision-making process for similar situations should begin with identifying the type of insurance and the nature of the claim. Next, the appraiser must research and identify the primary regulatory jurisdiction. In the U.S., this is typically the state where the policy was issued or where the loss occurred. Unless a specific federal law preempts state regulation for that particular type of insurance or claim, the appraiser should then consult the relevant state insurance department statutes, regulations, and bulletins to understand their obligations and the appraisal process. If there is any ambiguity regarding federal preemption, consulting with legal counsel specializing in insurance law is advisable. Question 9. The control framework reveals that a certified insurance appraiser, CIA, is tasked with valuing a residential property damaged by a covered peril. The insured, who is a personal acquaintance of the appraiser, suggests using several recently sold properties in the immediate neighborhood as comparables, noting their close proximity. However, upon initial review, these suggested properties appear to be in significantly better condition and possess more modern amenities than the subject property, even after accounting for typical market adjustments for condition. The appraiser is aware that other, slightly more distant, comparable properties exist that are more closely aligned in condition and features to the subject property. The appraiser must decide which comparables to prioritize in their valuation. Option A. Prioritize the comparables suggested by the insured due to their proximity, assuming that proximity is the most significant factor in determining value. Option B. Select a mix of comparables, including those suggested by the insured and others, without a clear methodology for weighting their influence to appear balanced. Option C. Prioritize comparables that are most similar in condition and features to the subject property, making objective adjustments for any minor differences, even if they are located slightly further away. Option D. Use only the comparables suggested by the insured, as their input is valuable and they are familiar with the local market. The correct answer is C. Prioritize comparables that are most similar in condition and features to the subject property, making objective adjustments for any minor differences, even if they are located slightly further away. Explanation. This scenario presents a professional challenge because it forces the certified insurance appraiser, CIA, to balance the principle of substitution with the potential for perceived bias or undue influence. The appraiser must maintain objectivity and adhere strictly to the established principles of value as defined by the regulatory framework governing CIAs, ensuring that the appraisal process is fair and defensible. The core of the challenge lies in applying the principle of substitution in a way that accurately reflects market value without being swayed by external pressures or personal relationships. The correct approach involves rigorously applying the principle of substitution by identifying comparable properties that are truly similar in location, size, condition, and features, and then making objective adjustments for any differences. This aligns with the regulatory requirement for CIAs to conduct appraisals based on sound valuation principles and to avoid any appearance of impropriety. The principle of substitution, cornerstone of property valuation, dictates that a buyer will not pay more for property than the cost of acquiring a substitute property with equivalent utility and desirability. Therefore, the appraiser's duty is to find the most relevant comparables and adjust them systematically to reflect the subject property's unique characteristics, thereby arriving at a market value that is supported by evidence and free from personal bias. This adherence to objective valuation methodology is paramount for maintaining professional integrity and complying with the CIA's ethical and regulatory obligations. An incorrect approach would be to favor comparables that are closer in proximity to the subject property, even if they are not as similar in condition or features, simply because they are easier to access or were suggested by the insured. This fails to uphold the principle of substitution by prioritizing convenience over accuracy and potentially misrepresenting market value. Ethically, this could be seen as a failure to act with due diligence and objectivity, potentially leading to an inaccurate appraisal and a breach of the appraiser's fiduciary duty to provide an unbiased assessment. Another incorrect approach would be to select comparables that are significantly superior in features or condition without making adequate upward adjustments to the subject property's value. This would violate the principle of substitution by overstating the value of the subject property and failing to reflect what a prudent buyer would realistically pay. This approach could also be interpreted as an attempt to appease the insured, which is an ethical failure and a violation of the CIA's duty to provide an objective valuation. The professional decision-making process for similar situations requires the appraiser to first identify the core valuation principles applicable to the situation, in this case, the principle of substitution. They must then gather a comprehensive set of potential comparable properties, critically evaluating each for true similarity. The appraiser should prioritize data-driven adjustments based on market evidence rather than subjective preferences or external suggestions. Maintaining detailed documentation of the selection process and the rationale for adjustments is crucial for defensibility and transparency. If faced with conflicting comparables or pressure to deviate from objective valuation, the appraiser must rely on their professional judgment, regulatory guidelines, and ethical standards to ensure the appraisal is accurate, unbiased, and compliant. Question 10. Performance analysis shows that a recent property loss has impacted multiple building systems, including HVAC, plumbing, and electrical. The insured has provided a contractor's estimate that details the proposed repairs. As a certified insurance appraiser, CIA, which approach best reflects a professional and regulatory compliant evaluation of these building systems? Option A. Reject the contractor's estimate outright and provide a significantly lower valuation based on a cursory visual inspection of the property. Option B. Independently verify the contractor's estimate by conducting a detailed, system-by-system assessment of the damage, considering the age and pre-loss condition of each component, and comparing proposed repairs and costs against industry standards and policy provisions. Option C. Accept the contractor's estimate at face value, as it represents the professional opinion of the party responsible for performing the repairs. Option D. Focus solely on the visible damage to the building's exterior and interior finishes, assuming that the underlying building systems are not significantly affected. The correct answer is B. Independently verify the contractor's estimate by conducting a detailed, system-by-system assessment of the damage, considering the age and pre-loss condition of each component, and comparing proposed repairs and costs against industry standards and policy provisions. Explanation. This scenario presents a professional challenge for a certified insurance appraiser, CIA, due to the inherent complexity of building systems and the potential for differing interpretations of their condition and repair costs. The appraiser must navigate the tension between accurately assessing damage, adhering to policy terms, and ensuring fair compensation for the insured, all within the strict confines of the regulatory framework governing insurance appraisals. The need for a best practice evaluation arises from the potential for disputes over the scope and cost of repairs, which can escalate into formal arbitration or litigation if not handled with diligence and adherence to established guidelines. The correct approach involves a thorough, systematic, and documented evaluation of each building system, considering its age, condition prior to the loss, and the extent of damage directly attributable to the covered peril. This approach aligns with the CIA's ethical obligations to conduct appraisals with integrity, impartiality, and competence, as mandated by the regulatory framework. Specifically, it requires the appraiser to act as a neutral party, applying objective standards to determine the actual cash value (ACV) or replacement cost value (RCV) of the damaged components, as stipulated by the insurance policy and relevant statutes. This methodical process ensures that all relevant factors are considered, leading to a fair and defensible appraisal. An incorrect approach would be to rely solely on the contractor's estimate without independent verification. This fails to uphold the appraiser's duty of impartiality and competence, as it delegates the core responsibility of appraisal to a party with a vested interest in maximizing repair costs. Such an approach risks overpaying for repairs, violating the principle of indemnity, and potentially contravening regulatory requirements for unbiased assessments. Another incorrect approach would be to dismiss the contractor's estimate entirely without a detailed, system-by-system review and justification. This demonstrates a lack of due diligence and could be perceived as arbitrary or unfair to the insured, potentially leading to disputes and a failure to meet the appraiser's obligation to conduct a comprehensive evaluation. It also fails to acknowledge the contractor's role in providing initial cost data, which, while needing verification, is a starting point for the appraisal process. A further incorrect approach would be to focus only on visible damage, neglecting the underlying structural and functional integrity of building systems. This superficial assessment would not accurately reflect the true cost of restoring the property to its pre-loss condition, potentially underestimating the claim and failing to meet the policy's indemnity provisions. It also overlooks the interconnectedness of building systems, where damage to one component can impact others. The professional decision-making process for similar situations should involve a commitment to a structured, evidence-based appraisal. This includes 1. Understanding the policy terms and conditions thoroughly. 2. Conducting a detailed site inspection, documenting all findings with photographs and notes. 3. independently verifying the scope and cost of repairs for each building system, comparing contractor estimates with industry standards, material costs, and labor rates. 4. Clearly articulating the rationale for all appraisal decisions, referencing specific policy provisions and damage assessments. 5. Maintaining open communication with all parties involved while remaining impartial. Question 11. Implementation of a business interruption appraisal for a multi-unit retail property damaged by a significant fire, where the insured is claiming substantial loss of rental income and ongoing operating expenses during the period of repair, requires the Certified Insurance Appraiser, CIA, to determine the actual loss sustained. Which of the following approaches best aligns with the regulatory framework and ethical guidelines for a CIA in this scenario? Option A. Estimate the loss by projecting the potential revenue of a hypothetical new tenant based on the property's location and size, assuming a quick lease-up and optimal operating performance. Option B. Assess the loss by analyzing the insured's historical financial records, including profit and loss statements and rent rolls, to project the income and expenses that would have been earned and incurred had the fire not occurred, and then deduct actual income and expenses during the restoration period. Option C. Determine the loss by focusing solely on the cost to repair the physical damage to the property, as this represents the direct financial impact of the fire. Option D. Calculate the loss based on the estimated rental income of comparable vacant retail units in the immediate vicinity, adjusted for current market vacancy rates. The correct answer is D. Calculate the loss based on the estimated rental income of comparable vacant retail units in the immediate vicinity, adjusted for current market vacancy rates. Explanation: this scenario presents a professional challenge due to the inherent complexities in appraising retail properties, particularly when dealing with a significant business interruption claim following a fire. The appraiser must navigate the nuances of determining actual loss sustained, which involves more than just the physical damage to the property. The challenge lies in accurately quantifying the loss of income and expenses during the period of restoration, while also considering the impact of market conditions and the potential for mitigation by the insured. Careful judgment is required to ensure the appraisal process is fair, objective, and compliant with the policy terms and applicable regulations. The correct approach involves a thorough assessment of the insured's financial records to determine the actual loss of income and ongoing expenses during the period of restoration. This includes analyzing historical profit and loss statements, rent rolls, and other relevant financial data to establish a baseline of normal operations. The appraiser must then project what the income and expenses would have been had the fire not occurred, and deduct the actual income and expenses incurred during the restoration period. This methodology aligns with the principle of indemnity, aiming to restore the insured to their pre-loss financial position without providing a profit. Regulatory frameworks for insurance appraisals, such as those governing the Certified Insurance Appraiser, CIA, designation, emphasize fairness, accuracy, and adherence to policy provisions. This approach is ethically sound, as it seeks to compensate the insured for their actual losses as defined by the policy. An incorrect approach would be to solely focus on the cost of repairing the physical damage to the retail property, disregarding the business interruption aspect of the claim. This fails to address the full scope of the insured's loss as stipulated in a business interruption clause, which is a critical component of many retail property insurance policies. Such an approach would violate the principle of indemnity by undercompensating the insured for their actual loss sustained. Another incorrect approach would be to estimate the loss of income based on speculative market trends without concrete financial data from the insured. While market conditions are a factor, the primary basis for business interruption claims must be the insured's historical performance and demonstrable losses. Relying on speculation rather than verifiable financial records introduces bias and deviates from the objective appraisal process mandated by regulatory bodies and ethical standards. A further incorrect approach would be to assume the insured has a duty to mitigate their losses by immediately relocating to a new, comparable property, without considering the feasibility, cost, and time involved in such a relocation. While mitigation is a factor, the appraisal process must account for reasonable efforts and costs associated with mitigation, rather than assuming immediate and cost-free relocation. This could lead to an unfair assessment of the restoration period and the associated losses. The professional decision-making process for similar situations should involve a systematic review of the insurance policy to understand the scope of coverage, particularly for business interruption. The appraiser must then gather all relevant documentation from the insured, including financial records and operational data. A detailed analysis of this information, combined with an understanding of the property's physical condition and the estimated time for repairs, will allow for an accurate and fair assessment of the actual loss sustained. Adherence to regulatory guidelines and ethical principles of objectivity and fairness is paramount throughout the appraisal process. Question 12. Which approach would be most appropriate for a certified insurance appraiser, CIA, to determine the settlement amount for damaged building and personal property under a building and personal property coverage form when the policy specifies actual cash value, but the insured believes the property was in pristine condition prior to the loss? Option A. Determine the replacement cost of the damaged property and then deduct depreciation based on the actual observed condition and remaining useful life of the property, as supported by documentation and industry standards, to arrive at the actual cash value. Option B. Settle the claim based on the insured's stated belief that the property was in pristine condition without applying any depreciation. Option C. Estimate the market value of the damaged property immediately before the loss and use that as the basis for settlement. Option D. Calculate the replacement cost of the damaged property and then deduct a standard depreciation percentage based on the age of the property. The correct answer is D. Calculate the replacement cost of the damaged property and then deduct a standard depreciation percentage based on the age of the property. Explanation. This scenario presents a professional challenge because the certified insurance appraiser, CIA, must accurately determine the value of damaged building and personal property under a specific policy, adhering strictly to the policy's terms and conditions and relevant regulatory frameworks. The core difficulty lies in distinguishing between actual cash value (ACV) and replacement cost value (RCV) when the policy language is ambiguous or when the insured's expectations differ from the policy's provisions. A CIA must possess a deep understanding of BPP coverage, including the nuances of depreciation, betterment, and the specific definitions within the policy and applicable regulations to avoid underpayment or overpayment, both of which carry significant ethical and regulatory implications. The correct approach involves a meticulous review of the building and personal property coverage form, specifically examining the definitions of actual cash value and replacement cost value, as they are defined within the policy and interpreted by the governing regulatory framework. This approach prioritizes adherence to the contractual agreement between the insurer and the insured, ensuring that the appraisal process is conducted in good faith and in accordance with established industry standards and legal requirements. Regulatory compliance is paramount, meaning the appraiser must operate within the bounds of the law and the policy, accurately applying depreciation only when ACV is the basis of settlement, and calculating RCV without unwarranted deductions for normal wear and tear or obsolescence, unless explicitly permitted by the policy or regulation. This ensures a fair and equitable settlement. An incorrect approach that focuses solely on the insured's perceived loss without reference to the policy's valuation method would be a significant regulatory and ethical failure. It bypasses the contractual obligations and could lead to an overpayment, which is a breach of fiduciary duty to the insurer and potentially a violation of regulations concerning proper claims handling and financial stewardship. Another incorrect approach that involves applying a standard depreciation percentage to all damaged items, regardless of their actual condition or the policy's valuation method, is also a failure. This demonstrates a lack of due diligence and an inability to apply the policy's terms accurately, potentially leading to an unfair settlement and violating the principle of good faith and fair dealing. Furthermore, an approach that prioritizes expediency over accuracy by making assumptions about the property's condition or value without proper investigation would be a failure to meet the professional standards expected of a CIA, potentially violating regulations that mandate thorough and accurate appraisals. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the policy's BPP coverage, including the chosen valuation method, ACV or RCV. Second, meticulously inspect and document the damage, assessing the condition of the property both before and after the loss. Third, apply the policy's valuation method, including any applicable depreciation for ACV settlements, based on the actual condition of the property and regulatory guidelines. Fourth, clearly communicate the appraisal findings and the basis for the valuation to all parties involved, ensuring transparency and adherence to ethical principles. Question 13. The analysis reveals that a certified insurance appraiser, CIA, is assigned to assess a significant property damage claim following a severe storm. During the initial inspection, the insured expresses distress and presents a preliminary estimate that appears considerably higher than the appraiser's initial visual assessment. The insured mentions a close personal acquaintance with the appraiser's supervisor at the insurance company, implying that a favorable assessment would be appreciated. The appraiser suspects the insured's estimate may be inflated, but also feels a subtle pressure to maintain a good working relationship with the insured and avoid prolonged disputes. What is the most ethically and regulatorily sound approach for the appraiser to take? Option A. Conduct a thorough, independent assessment based on policy terms, industry standards, and documented evidence, disregarding any personal connections or implied pressures, and clearly communicate the findings and methodology to all parties. Option B. Inform the insured that due to the personal connection mentioned, it would be best to have another appraiser handle the claim, without conducting any assessment or providing any preliminary feedback. Option C. Advise the insured that their estimate is likely too high and proceed with a significantly reduced valuation based on the appraiser's initial visual impression, without detailed documentation, to manage expectations. Option D. Accept the insured's preliminary estimate as a starting point for negotiation, acknowledging the insured's distress and personal connection to the supervisor, to expedite the claim resolution process. The correct answer is A. Conduct a thorough, independent assessment based on policy terms, industry standards, and documented evidence, disregarding any personal connections or implied pressures, and clearly communicate the findings and methodology to all parties. Explanation. The analysis reveals a scenario that is professionally challenging due to the inherent conflict between the appraiser's duty to accurately assess loss and the potential for personal gain or pressure from a party involved in the claim. The appraiser must navigate this situation with utmost integrity, ensuring that their assessment is objective and solely based on the evidence and established appraisal principles, without bias or undue influence. The core of the challenge lies in maintaining professional independence and upholding the trust placed in them by all parties involved in the insurance process. The correct approach involves a commitment to impartiality and a thorough, evidence-based assessment. This means meticulously documenting all findings, adhering strictly to the policy terms and conditions, and applying industry-standard appraisal methodologies. The appraiser must resist any temptation to inflate or deflate the loss value based on external pressures or personal relationships. This approach is ethically and regulatorily sound because it aligns with the fundamental principles of insurance appraisal, which demand fairness, accuracy, and transparency. Specifically, it upholds the appraiser's fiduciary duty to provide an unbiased evaluation, preventing misrepresentation of the loss and ensuring that the settlement is equitable for both the insured and the insurer, as mandated by general insurance appraisal ethics and any applicable state-specific regulations governing adjusters and appraisers that emphasize good faith and fair dealing. An incorrect approach would be to accept the insured's inflated estimate without independent verification. This fails to uphold the appraiser's responsibility to conduct a thorough and objective assessment. Ethically, it constitutes a dereliction of duty, as it prioritizes expediency or a desire to please over accuracy. Regulatorily, it could be viewed as misrepresentation or a failure to act in good faith, potentially leading to disciplinary action. Another incorrect approach would be to significantly undervalue the loss based on a personal relationship with the insurer's representative or a desire to expedite the claim for the insurer's benefit. This demonstrates bias and a lack of professional integrity. It violates the principle of fairness and impartiality, potentially leading to an inequitable outcome for the insured and exposing the appraiser to accusations of bad faith and professional misconduct. Such actions undermine the credibility of the appraisal process and can have legal and regulatory repercussions. The professional decision-making process for similar situations should involve a clear understanding of the appraiser's ethical obligations and regulatory requirements. When faced with conflicting pressures or potential biases, the appraiser should 1. Reaffirm their commitment to impartiality and objectivity. 2. Gather all relevant evidence and documentation. 3. Conduct a thorough and independent assessment based on established appraisal standards and policy provisions. 4. Document all findings and the rationale behind their conclusions meticulously. 5. If personal relationships or external pressures create a conflict of interest, consider recusal or seeking guidance from a supervisor or professional body. 6. Always prioritize accuracy, fairness, and adherence to regulatory guidelines. Question 14. Compliance review shows that a certified insurance appraiser, CIA, is tasked with determining the value of a damaged commercial property. The insurer has provided an initial repair estimate, and the policyholder has submitted a contractor's bid. The CIA is considering how to proceed with the appraisal. Which of the following approaches best aligns with the principles and practices expected of a CIA under the relevant regulatory framework? Option A. Independently inspect the property and gather multiple, verifiable data points for comparable properties or repair costs to establish a well-supported valuation. Option B. Utilize the policyholder's contractor's bid exclusively, as it represents the cost the policyholder is seeking. Option C. Accept the insurer's initial repair estimate as the basis for the appraisal, as it is provided by the party initiating the claim. Option D. Focus primarily on the potential cause of the damage, as understanding the origin is crucial for determining the extent of the loss. The correct answer is A. Independently inspect the property and gather multiple, verifiable data points for comparable properties or repair costs to establish a well-supported valuation. Explanation. This scenario presents a professional challenge because it requires the certified insurance appraiser, CIA, to navigate conflicting appraisal principles while adhering strictly to the regulatory framework governing insurance appraisals. The core of the challenge lies in balancing the principle of achieving a fair and impartial valuation with the practicalities of the appraisal process, particularly when faced with potentially biased information or differing interpretations of damage. The CIA must exercise sound judgment to ensure the appraisal process remains objective and defensible. The correct approach involves a thorough and objective assessment of the damaged property, utilizing multiple comparable sales or repair cost data points to establish a well-supported valuation. This aligns with the fundamental appraisal principle of objectivity and impartiality, which is a cornerstone of ethical appraisal practice and is implicitly or explicitly mandated by regulatory guidelines for CIAs. The regulatory framework emphasizes the appraiser's duty to provide an unbiased opinion of value, free from undue influence or personal bias. By employing a comparative analysis that considers a range of relevant data, the CIA demonstrates adherence to this duty, ensuring the appraisal reflects the true market value or repair cost, thereby fulfilling their professional obligation. An incorrect approach that relies solely on the insurer's initial estimate without independent verification fails to uphold the principle of impartiality. This approach risks perpetuating any inaccuracies or biases present in the insurer's initial assessment, potentially leading to an unfair outcome for the policyholder. Ethically and regulatorily, an appraiser cannot simply rubber stamp another party's valuation. They must conduct their own due diligence. Another incorrect approach that prioritizes speed over accuracy by using a single, potentially unverified comparable property or repair estimate is also professionally unacceptable. It shortcuts the rigorous process required for a defensible appraisal and violates the principle of due diligence. Regulatory bodies expect appraisers to employ robust methodologies that support their conclusions, not superficial ones. A third incorrect approach that allows personal opinions or assumptions about the cause of damage to unduly influence the valuation, rather than focusing on the extent of the damage itself, is also a failure. The appraiser's role is to value the damage as it exists, not to adjudicate fault or speculate on origins beyond what is necessary to understand the scope of the loss. This deviates from the objective valuation mandate and can lead to an inequitable appraisal. The professional decision-making process for similar situation should involve a systematic approach. 1. Understand the scope of the appraisal assignment and the specific regulatory requirements. 2. Gather all relevant documentation and information, including policy details, loss reports, and any initial estimates. 3. Conduct an independent and thorough inspection of the damaged property. 4. Employ appropriate appraisal methodologies such as comparative market analysis or cost approach, using multiple verifiable data points. 5. Critically evaluate all gathered data for accuracy and relevance. 6. Formulate an opinion of value or repair cost that is well supported by the evidence and consistent with regulatory standards. 7. Clearly document the appraisal process, methodologies, and findings. 8. Maintain strict impartiality and objectivity throughout the entire process, avoiding any undue influence. Question 15. The risk matrix shows a high probability of significant financial loss due to a covered peril impacting a retail establishment's operations. As a certified insurance appraiser, you are tasked with evaluating the business income coverage claim. Which approach best aligns with the regulatory framework and ethical obligations for determining the loss of income? Option A. Focus solely on the cost to repair the physical damage to the premises, as this is the primary indicator of the extent of the business interruption. Option B. Estimate the lost income based on the visible damage to the storefront and a general understanding of retail sales. Option C. Apply a standard industry percentage of lost sales to the estimated repair timeline, without specific reference to the insured's financial performance. Option D. Conduct a detailed analysis of the insured's historical financial records, including sales, cost of goods sold, and ongoing expenses, to project the income that would have been earned during the period of restoration, considering any mitigating actions taken by the insured. The correct answer is B. Estimate the lost income based on the visible damage to the storefront and a general understanding of retail sales. Explanation. This scenario is professionally challenging because it requires the certified insurance appraiser, CIA, to move beyond a simple assessment of physical damage and delve into the complex, often subjective realm of business interruption. The CIA must accurately quantify the loss of income resulting from a covered peril, a task that demands a thorough understanding of the insured's business operations, financial records, and the specific terms of the business income coverage. The risk matrix highlights the potential for significant financial impact on the insured, necessitating a precise and defensible appraisal. The correct approach involves a detailed analysis of the insured's historical financial performance, considering factors such as gross earnings, ongoing charges, and any mitigating actions taken by the insured. This approach aligns with the fundamental principles of insurance appraisal, which mandate a fair and accurate determination of the loss. Specifically, under the regulatory framework governing certified insurance appraisers, the appraisal process is designed to resolve disputes regarding the amount of loss. For business income coverage, this means meticulously reconstructing the income that would have been earned had the loss not occurred, and then deducting expenses that ceased due to the interruption. This requires adherence to the policy's definition of gross earnings and period of restoration, ensuring that the appraisal reflects the actual financial impact and is not speculative. Ethical considerations also demand impartiality and a commitment to accurately representing the loss to both the insurer and the insured. An incorrect approach that focuses solely on the physical damage assessment fails to address the core of business income coverage, which is the loss of earnings, not the cost of repairs. This neglects the contractual obligation of the insurer to indemnify the insured for lost income. Another incorrect approach that relies on broad estimations without substantiating them with the insured's financial data violates the principle of accurate loss determination and may lead to an unfair appraisal, potentially exposing the CIA to regulatory scrutiny for failing to conduct a thorough investigation. A third incorrect approach that prematurely closes the appraisal period without considering the full extent of the business's recovery time would also be a failure, as it would not accurately reflect the duration of the income loss as defined by the policy. Professionals should approach such situations by first thoroughly understanding the policy's business income provisions, including definitions, limitations, and the period of restoration. They should then gather all relevant financial documentation from the insured, including profit and loss statements, tax returns, and sales records. A systematic reconstruction of projected income, accounting for seasonality and market trends, is crucial. Engaging with the insured to understand their business operations and any efforts to mitigate losses is also vital. The appraisal should be a transparent process, with clear communication and documentation of all findings and methodologies used. Question 16. Cost-benefit analysis shows that while actual cash value Act might offer a quicker settlement for the insurer by accounting for depreciation, the policy contract and governing statutes for this jurisdiction clearly stipulate replacement cost, RC, for covered losses. As a certified insurance appraiser, CIA, How should you proceed to ensure compliance and fairness in valuing the damaged property? Option A. Value the property at replacement cost, but apply a standard depreciation percentage to reflect the age and condition of the damaged items, even if not explicitly allowed by the policy. Option B. Value the property at replacement cost, as stipulated by the policy and statutes, ensuring the insured can repair or replace the damaged items with new ones of like kind and quality. Option C. Value the property at actual cash value, as it represents the depreciated value of the damaged items and may lead to a more cost-effective resolution for the insurer. Option D. Seek to negotiate a settlement based on actual cash value, explaining to the insured that it is a common industry practice for older items. The correct answer is B. Value the property at replacement cost, as stipulated by the policy and statutes, ensuring the insured can repair or replace the damaged items with new ones of like kind and quality. Explanation. This scenario is professionally challenging because it requires the Certified Insurance Appraiser, CIA, to navigate the nuanced distinction between actual cash value (ACV) and replacement cost (RC) in a way that aligns strictly with the regulatory framework governing insurance appraisals within the specified jurisdiction. The challenge lies in applying the correct valuation method based on policy language and applicable statutes, even when one method might appear more financially advantageous to a party. Careful judgment is required to ensure fairness and compliance, preventing potential disputes and upholding the integrity of the appraisal process. The correct approach involves determining the valuation method mandated by the insurance policy and relevant statutes. If the policy specifies replacement cost, the appraisal must reflect the cost to repair or replace the damaged property with materials of like kind and quality, without deduction for depreciation. This aligns with the regulatory intent to restore the insured to their pre-loss condition, as often stipulated in insurance statutes and regulations designed to protect policyholders. Adhering to the policy's RC provision is ethically sound and legally required, ensuring the insured receives the full benefit they contracted for. An incorrect approach would be to default to actual cash value when the policy clearly states replacement cost. This failure to adhere to the policy terms constitutes a regulatory violation, as it deprives the insured of the coverage they purchased. Ethically, it is a breach of good faith and fair dealing. Another incorrect approach would be to unilaterally apply depreciation to a replacement cost valuation without explicit policy authorization or statutory allowance. This misinterprets the RC provision and can lead to an underpayment, violating the principle of making the insured whole. Professionals should employ a decision-making framework that begins with a thorough review of the insurance policy, paying close attention to the valuation clause, ACV RC. This must be followed by an examination of the applicable state statutes and regulations governing insurance appraisals and claims. The appraiser must then objectively determine which valuation method is contractually and legally required. If the policy mandates RC, the appraisal must be conducted on that basis, considering all relevant factors for RC valuation. Any deviation must be supported by clear policy language or statutory exception, and any ambiguity should be resolved in favor of the policyholder, consistent with regulatory principles of consumer protection. Question 17. Quality control measures reveal that a property being appraised for insurance purposes has undergone extensive renovations that were not obtained with the necessary permits. The appraiser must determine the most appropriate valuation approach to accurately reflect the property's value in its current state, considering the unpermitted nature of the work. Option A. Primarily utilize the cost approach, adjusting for depreciation and obsolescence, and explicitly account for the diminished market value and potential remediation costs associated with the unpermitted renovations. Option B. Focus exclusively on the as-is market value as determined by a quick visual inspection, disregarding any potential long-term implications of the unpermitted work. Option C. Value the property based on the reported cost of the renovations, assuming all work was completed to code and is fully insurable, regardless of permit status. Option D. Solely rely on the most recent comparable sales data for similar properties in the area, without further investigation into the specifics of the unpermitted renovations. The correct answer is A. Primarily utilize the cost approach, adjusting for depreciation and obsolescence, and explicitly account for the diminished market value and potential remediation costs associated with the unpermitted renovations. Explanation. This scenario presents a professional challenge because the Certified Insurance Appraiser, CIA, is tasked with valuing a property that has undergone significant unpermitted renovations. The core difficulty lies in reconciling the market value of the property with the actual cost of repairs, especially when those repairs deviate from standard building codes and may not be recognized by the insurance market or future buyers. The CIA must navigate the ethical obligation to provide an accurate and fair valuation, while adhering to the regulatory framework governing insurance appraisals, which emphasizes adherence to established valuation methodologies and legal building standards. The correct approach involves utilizing the cost approach, adjusted for depreciation and obsolescence, while also considering the diminished market value due to the unpermitted nature of the renovations. This approach is correct because it directly addresses the physical condition of the property and the cost associated with its current state, which is a fundamental principle in property appraisal. Regulatory guidelines for insurance appraisers typically mandate the use of recognized appraisal methodologies. By acknowledging the unpermitted work, the CIA is ethically bound to reflect the reality of the property's condition and its marketability, which may be negatively impacted by noncompliance with building codes. This ensures a valuation that is both technically sound and ethically responsible, preventing the policyholder from receiving an inflated payout for work that may not be insurable or marketable. An incorrect approach would be to solely rely on the as-is market value, without adequately accounting for the cost of bringing the unpermitted renovations up to code or the potential for future remediation. This fails to address the underlying cost of the physical asset and the inherent risks associated with unpermitted work, potentially leading to an inaccurate appraisal that does not reflect the true replacement or repair cost. Another incorrect approach would be to ignore the unpermitted nature of the renovations and value the property as if all work was compliant. This is ethically unsound and violates regulatory principles by misrepresenting the property's condition and its compliance with legal standards, potentially leading to future disputes and financial losses for either the insurer or the insured. Professionals should employ a decision-making framework that prioritizes adherence to established appraisal methodologies, regulatory compliance, and ethical considerations. This involves a thorough investigation of the property's condition, identification of any non-compliant or unpermitted work, and the application of appropriate valuation techniques that account for these factors. The CIA must exercise professional judgment to determine how unpermitted renovations impact both the cost of repair and the overall market value, ensuring the appraisal is fair, accurate, and defensible. Question 18. Consider a scenario where a certified insurance appraiser, CIA, is tasked with valuing a rare, handcrafted 18th century grandfather clock for an insurance claim. There are no identical clocks listed for sale or recently sold in the immediate geographic area. The appraiser has identified several antique clocks from the same era and of similar craftsmanship, but they vary in maker, condition, and specific features. Which valuation methodology, when applied with appropriate adjustments and thorough documentation, best aligns with the regulatory framework for determining the fair market value of such personal property? Option A. Primarily utilizing the market data approach by identifying the closest comparable antique clocks and making detailed adjustments for differences in maker, condition, and features, supported by extensive research into auction records and dealer inventories. Option B. Applying the income approach, estimating the potential rental income the clock could generate if used in a commercial setting. Option C. Solely employing the cost approach, estimating the cost to reproduce a similar clock with contemporary materials and labor, and then depreciating it based on age. Option D. Relying on a subjective assessment of the clock's sentimental value to the insured, without reference to market data or cost considerations. The correct answer is A. Primarily utilizing the market data approach by identifying the closest comparable antique clocks and making detailed adjustments for differences in maker, condition, and features, supported by extensive research into auction records and dealer inventories. Explanation. This scenario presents a professional challenge because the certified insurance appraiser, CIA, must determine the fair market value of a unique, handcrafted antique armoire for an insurance claim. The challenge lies in the absence of readily available comparable sales data for such a specific item, requiring a nuanced valuation approach that adheres strictly to the regulatory framework governing insurance appraisals. The CIA must balance the need for accuracy with the ethical obligation to provide an unbiased and well-supported valuation, ensuring the insured receives fair compensation without overpaying the claim. The correct approach involves a comparative market analysis, specifically utilizing the cost approach and market data approach in conjunction, with a strong emphasis on the latter where possible, even if adjustments are significant. This is justified by the regulatory framework, which mandates that appraisals reflect the actual cash value or replacement cost, as defined by the policy and applicable statutes. The market data approach, even with unique items, requires the appraiser to identify the closest possible comparable sales, adjusting for differences in condition, age, provenance, and craftsmanship. When direct comparables are scarce, the appraiser must document the research process thoroughly, including the sources consulted and the rationale for any adjustments made. This aligns with the ethical duty of diligence and the regulatory requirement for appraisals to be based on sound valuation principles and verifiable data. An incorrect approach would be to solely rely on the income approach. This approach is generally unsuitable for personal property like an armoire, as it focuses on the potential income-generating capacity of an asset, which is not relevant for a household item. Applying this would violate the regulatory mandate to value the item based on its intrinsic worth and market desirability, not hypothetical income. Another incorrect approach would be to use a purely cost approach without considering market realities. While the cost to replace or reproduce the armoire might be a factor, it does not necessarily reflect its current market value, especially for an antique. Over-reliance on this method without market validation could lead to an inflated or deflated valuation, failing to meet the regulatory standard of fair market value. Finally, an appraiser failing to document their methodology and the comparables used, or making arbitrary adjustments without justification, would be a significant ethical and regulatory failure, undermining the integrity of the appraisal process and potentially leading to disputes. Professionals should approach such situations by first thoroughly understanding the policy terms and applicable regulations. They should then conduct extensive research, seeking out any available data, even if imperfect. When direct comparables are scarce, the appraiser must clearly articulate the methodology used, the adjustments made, and the rationale behind them, ensuring transparency and defensibility. This systematic and documented process, grounded in regulatory requirements and ethical principles, is crucial for making sound professional decisions. Question 19. The performance metrics show a pattern where appraisers in a specific region are consistently reporting higher than market value estimates for property damage claims, particularly in areas experiencing rapid economic development. As a certified insurance appraiser, CIA, what is the most appropriate response to this observed trend? Option A. Focus on expediting claim settlements by prioritizing speed over absolute adherence to precise market value definitions, assuming minor deviations are acceptable in dynamic markets. Option B. Consult with local real estate agents to gain a qualitative understanding of market sentiment and incorporate this subjective insight into appraisal valuations to better reflect perceived market growth. Option C. Adjust appraisal methodologies to reflect the general upward trend in market values observed in rapidly developing areas, even if specific supporting data for each claim is less robust. Option D. Review appraisal methodologies to ensure they are strictly adhering to the jurisdiction's defined market value standards, utilizing verifiable data and established valuation techniques, and documenting all findings objectively. The correct answer is D. Review appraisal methodologies to ensure they are strictly adhering to the jurisdiction's defined market value standards, utilizing verifiable data and established valuation techniques, and documenting all findings objectively. Explanation. The performance metrics show a consistent trend of appraisers within a firm reporting higher than market value estimates for property damage claims, particularly in areas experiencing rapid economic development. This scenario is professionally challenging because it creates a conflict between the appraiser's duty to accurately assess damage and the potential for perceived or actual bias that could benefit the insurer or the insured, depending on the appraiser's incentives or interpretation of market value. The Certified Insurance Appraiser (CIA) designation implies a commitment to ethical conduct and adherence to specific regulatory frameworks governing insurance claims and appraisals. The correct approach involves a rigorous and objective application of established appraisal principles and methodologies, grounded in the specific regulatory framework governing insurance appraisals in the relevant jurisdiction. This means relying on verifiable data, industry-standard valuation techniques, and a clear understanding of what constitutes market value as defined by applicable laws and regulations. For a CIA, this includes understanding the nuances of how economic development might influence market value, but not to the extent that it deviates from objective, data-driven assessments. The regulatory framework for insurance appraisers typically mandates impartiality, accuracy, and adherence to defined appraisal processes to ensure fair outcomes for all parties involved in an insurance claim. An incorrect approach would be to allow subjective interpretations or external pressures, such as the desire to expedite claims or maintain good relationships with insurers or policyholders, to influence the appraisal outcome. For instance, if an appraiser begins to consistently inflate estimates based on a general perception of rising market values without concrete, localized data to support each specific appraisal, this deviates from the principle of objective assessment. This could be considered a failure to adhere to the regulatory requirement for fair and accurate appraisals. Another incorrect approach would be to adopt a methodology that is not recognized or permitted by the governing regulatory body, even if it appears to align with current market trends. This would violate the mandate to follow established appraisal procedures and could lead to disputes and regulatory scrutiny. Professionals should approach such situations by first consulting the specific statutes, regulations, and any relevant case law that define the appraiser's duties and the standards for property valuation in their jurisdiction. They should maintain detailed records of their data sources and methodologies for each appraisal. If performance metrics suggest a systemic issue, the professional should proactively seek clarification from regulatory bodies or professional organizations regarding the interpretation of valuation standards in dynamic market conditions. Continuous professional development focused on ethical appraisal practices and regulatory updates is crucial for navigating these complexities. Question 20. The audit findings indicate that an appraiser, when assessing a claim under coverage A, bodily injury and property damage, included the estimated cost of lost business income and the expense of bringing undamaged portions of the building up to current code in their valuation. Based on standard U.S. insurance regulatory frameworks and common policy language for coverage A, which of the following appraisal approaches best aligns with regulatory compliance and the principle of indemnity? Option A. Incorporating the cost of bringing the entire property, including undamaged sections, to current building codes to ensure the insured has a fully compliant and modern facility. Option B. Valuing only the direct physical damage to the insured property caused by the covered peril, excluding any indirect financial losses or costs associated with upgrading undamaged property. Option C. Including the estimated lost business income resulting from the property damage, as this represents a significant financial consequence for the insured. Option D. Estimating the cost to repair or replace the damaged property and adding a buffer for potential future code compliance issues that may arise during reconstruction. Correct answer is B. Valuing only the direct physical damage to the insured property caused by the covered peril, excluding any indirect financial losses or costs associated with upgrading undamaged property. Explanation. This scenario is professionally challenging because it requires an appraiser to navigate the complexities of coverage A, specifically distinguishing between direct physical loss and consequential damages, while adhering strictly to the policy language and applicable state insurance regulations. The appraiser must exercise sound judgment to avoid misinterpreting the scope of coverage, which could lead to underpayment or overpayment of claims, impacting both the insured and the insurer. The correct approach involves meticulously reviewing the policy's definition of direct physical loss and comparing it against the documented damages. This approach is right because it aligns with the fundamental principle of insurance contracts, which is to indemnify the insured for direct, accidental physical loss or damage. State insurance regulations typically mandate that claims handling and appraisal processes be conducted in good faith and in accordance with policy terms. By focusing solely on physical damage directly caused by the covered peril, the appraiser ensures compliance with coverage as written and avoids expanding coverage beyond what was contracted. An incorrect approach that focuses on lost business income or other indirect financial losses is professionally unacceptable. This fails because coverage typically pertains to direct physical damage to property, not consequential economic losses. Such losses are often covered under separate policy provisions, e.g., business interruption coverage, and are not part of the direct physical damage assessment under Coverage A. Misinterpreting this distinction constitutes a failure to adhere to the policy's plain language and regulatory requirements for accurate claims assessment. Another incorrect approach that includes the cost of upgrading undamaged portions of the property to meet current building codes is also professionally unacceptable. While building code upgrades may be necessary for repairs, they are generally not considered part of the direct physical loss unless the policy specifically includes such endorsements or the damage is so extensive that code compliance is mandated for the repair of the damaged portion. This approach risks overestimating the claim by including betterment rather than just restoration, violating the principle of indemnity and potentially breaching regulatory guidelines against paying for improvements not necessitated by the covered loss. The professional decision-making process for similar situations should involve a systematic review of the policy contract, focusing on the definitions of key terms like direct physical loss and covered peril. The appraiser must then gather all relevant documentation, including the claim report, adjuster's findings, and any expert reports, to assess the nature and extent of the damage. A critical step is to cross-reference the observed damages against the policy provisions and applicable state regulations. When in doubt about the interpretation of coverage, consulting with legal counsel or the insurer's claims department is a prudent step to ensure compliance and maintain professional integrity.